Hey guys, I got a good question today, or it'd be yesterday now by the time you guys see this in my live stream this morning. It was about the lightning spread and the mechanics of the lightning spread. So I back tested the lightning spread in a bunch of single stocks, and we're going to look at that in a second. But right now, I want to explain the mechanics of it. Now, the lightning spread's new, and it's not nearly as misunderstood as ULTY is. ULTY is a great stock for sure, a great ETF, and so is the lightning spread. The only one that's doing the lightning spread right now that I know of is BLOX, BLOX. BLOX it's one of the best ideas out there. It's going to be $1 billion fund someday. It's really a really good ETF out there. It's from X Funds. I'm trying to get the principal, David, to come on the show. So hopefully he'll come on soon. So look at, all right. So let's break the lightning spread down to its parts. And then and this is important that you understand how it works and what path dependency means and does to you in option strategies. And then after that, I'm going to show you the back test. And we may do a little back test between now and then. So the lightning spread it's two parts. It's an out of the money bull put spread. I'm using the 30 delta and the 20 delta for kind of a good proxy. Now they don't have one way that they do it at X Funds. But I'm kind of generalizing here, but we'll use the 30 delta. And right there, that's the 32 delta. And we're selling that put. And that's great. That's awesome. That's what brings in money. That makes us $295. We get $295 for that. Then at the same time, we're spending $65. We're going a few more strikes out of the money just to cap our max loss. It doesn't mean the lightning spread can't lose money, but it means that this part of the lightning spread, the lightning spread's two parts. And I think that's where there's some consternation. So this is one part of the lightning spread. It's these two options, it's selling these puts. All right. Then in addition to that, you have to add, if you're doing it in option strat, you have to add stock, add by Google. Okay. So that's the entire lightning spread right there. And you can see the shape is kind of a zigzag lightning shape here. The lightning spread gives you double exposure to the market. The stock gives you single exposure to the market. The lightning spread gives you double exposure to the market, but only between the strikes. But between the strikes of 175 and 185, you're going to lose at twice as fast of a rate because you're double long. You're essentially long 200 shares of stock between 185 and 175. Under 175, you're back to only long 100 shares of stock, which is just the Google that you own. It's just important to break this down and understand what's happening here. So the stock is just stock. It goes up and down just like stock does. The anytime you're selling options, the options obligates you to do something on the other end, but only in certain circumstances. And that's where the path dependency, that's where what path the underlying takes makes a big difference in the return stream. Okay, so like we said, we're double long between 185 and 175. So what this obligates us to do, because we sold a 185 put, that obligates us to buy Google at 185. Now, they aren't going to really buy Google in the lightning spread. They aren't trying to get extra shares of stock. Even if they do end up with Google, they'll just sell it right away. But it does obligate you to buy the stock. Lots of times they can just settle up for cash without having to buy the stock. But you'll either have to buy the stock or you'll have the equivalent loss that would have happened had you had to buy the stock. There's no way to get around that. That's what you're agreeing to do when you sell the 185 put. The good thing is you're only liable down to 175, but that gives you double exposure between the two strikes, right? Okay, so that's the way they do it. So let's look at let's look at why Jay, what the lightning spread will do for you and what it won't. Okay, so we'll just stick with Google because that's on the other page. We'll just stick with Google. Okay, so here we have in the back tester, we have the two parts of lightning spread: buy 100 shares of stock, and then sell a 30 delta put and buy a 20 delta. That's a basic kind of overgeneralized. It's not exactly what they might use, but it could be similar. All right, so when I say it has two parts, let's forget about the stock for now. Let's remove the stock and just see what just selling a put spread will do. Now, you don't have any unlimited loss to the downside, which is good, and you bring in a yield. But let's just sell that put spread for the past 2 years and see what happens in Google. Okay. Well, so the put spread strategy lost $911. It tied up $1,500 of used capital, but it was down 79% at the worst spot. That's half of the lightning spread, and this is still a really good strategy. You may not realize it when you look at this. So the problem with this is the market. If you just did this strategy, the market over the same time made $876. If you invested $1,521 in Google, you were up about 50%, or 57.62 actually, Okay, so what Jay is doing is you don't want to just run this put spread by itself. You can, if you sacrifice all your upside and you expose yourself to double downside. But here's the reason they do the lightning spread. See that average premium, $49. So they earn that every 5 days. Over the course of 2 years, that came to a total premium of $5,100. And this strategy only tied up $1,500. So these put spreads are great at generating income, but they're terrible at giving you exposure to the stock. In fact, the stock went up and you lost money if you just did the put spread. All Jay did is he combined this strategy, and he's using this to get the income to pay the yield. This does make $50 a week just on average, or $5,100 over 2 years. That's pretty good. So what he's done is he's combined that trade. Remember, that trade's a big loser by itself, but he's combined that trade with a stock leg. Now let's run that back for 2 years and see what that looks like. Okay, so now we have a strategy that it tied up more money because you have 100 shares of stock and you're selling the put spreads at the same time. So it tied up $21,000. Okay, and it made $2,800 total return. Okay, now in the same time frame, the market made $12,000 total return. So but in any event, you can see that combining it with the stock made the results much better. What you have to consider anytime you do an option strategy to earn an income is it obligates you to do something. You can sell puts, and when you do that, especially when you sell out of the money puts, you push all the risk off down to the downside over there. So that means, as far as path dependency, that means if you're doing a strategy like the lightning spread, or even just like selling puts, as long as you don't have any big down days that go past the 185 strike, you won't ever have to, I call it pay the toll, or you won't ever have to realize the true cost of it. But that's not realistic. What's going to happen when you do this systematically every day or every week? I'm simulating doing this every week. You're going to have some weeks that are really bad, and you are going to have to pay the toll. So it matters not only where the market ends up, but how the market gets there. That's the path dependency. So if you look at this, and I'm going to prove this in the back tester, you can look at a lightning spread strategy against a covered call strategy. So on the covered call strategy, we're going to do the same basic thing. We're going out of the money on top of the market and selling. We'll sell a 30 delta call just to be consistent. We were selling a 30 delta put, and that's 1 or 2, 3 strikes out of the money. So the 30 delta call in this case is 1, 2, 3 strikes out of the money. There it is, 31 delta. So that's a covered call strategy. So now we have a covered call strategy. The covered call strategy is in red and green. The lightning spread's in white. So you can look at them and see how it's going to do and see how the path dependency is going to happen. Now, if you have a lot of weeks where the market goes up more than 4.2% in this example, you can see the lightning spread strategy keeps getting upside. If the market goes nowhere, it's really about the same. If you want to zoom in on it, it's pretty much the same if the market goes nowhere. You do a little better with the covered call if the market goes nowhere, but not significantly. The problem is if you have a week where the market drops and the market drops more than 3.2%. All right, then you have to realize the loss and you have to pay the toll. And you can see it gets pretty wide here. And that's going to mess up your return stream. It's not going to mess up your return stream, but it's going to give you a return stream where you're going to do worse in down markets compared to the covered call strategy because you're pushing all your risk off to the downside. And this is a great strategy. I'm not throwing shade at the lightning spread. This is the greatest strategy ever, but it's just important to know how it works. So let's go back to the lightning spread. And let's look. Let's just look at the spread by itself and see what it really obligates you to do. So, or let's see what the max risk is. So you made $295 less $64. You made a credit of $229. But you have, let's see, take the stock off of here. Okay, you made $229, but your max loss is $770. Well, why is that? Well, 185 and 175 are 10 strikes apart, or 10 points apart. So 10 times 100 is 1,000. So your max risk in a spread like this is the width of the strikes less the credits you receive. So if you take 1,000 and subtract 229.50, you get 770.50. Okay, that's your max exposure on the deal. The problem is, though, not really a problem, but where that gets you is right here. In the bigger down days, it is 770. You do whatever the stock would do because you have stock, and you also, but it makes the fund perform $770 worse because you have to pay the toll. So if you have a week, if you have 4 down weeks or something, you will have a bad return stream. And if you compare it to just the stock, the underlying, you might not be doing as well. And definitely if you compare it to just the covered call, you won't be doing as well because you push the risk off to the downside and the market went down. So the lightning spread gives you a situation where if it goes past the strikes, you add $770 or subtract $770 from your total return. So it hurts you. If it goes nowhere, it's roughly the same. But the beauty of it is if it goes up, you should keep making money on the upside, just like a stock would. Okay, so let's look at this on. Let me prove that to you. Let's go back to 2022, which was a bad market. Let's look at the lightning spread and see how we did. And I'm going to tell you it's not going to be very good because of the path dependency. In 2022, there was a lot of days where the market went down. So, but let's see. It may still do better than the stock overall. The thing is, the market doesn't just go down. In 2022, it also goes up some days. So your total return is what happens over a long enough time frame. All right, but just to look at this, in 2022, the lightning spread strategy was down 33%, whereas just buying and holding stock was down 34%. However, it wasn't a total waste. If you bought and hold stock, you would have also been down 34% for the year. Well, the lightning spread was only down 28% from the year. So the lightning spread did add alpha. It was a bad year. You should have lost 34. You ended up just losing 28. That's great. And your max risk is a little bit less. Doesn't make the lightning spread bad, but if we do a covered call with the same stock, we're just going to switch it to sell call. 100 shares of Google, sell call. We'll do it over the same time frame. It's going to do way better. And why is that? Where do we push our risk off? When we're selling a call, push our risk off that way. It's that way to me. It's probably that way to you, but I'm just thinking of options trend. All right, so we push our risk off to the bullish side. So we'd probably be all right in 2022 because we had a lot of days we didn't have to pay the toll. We didn't have to realize any ill effects from the option overlay. Sure enough, look at this. It was only down 24% in the same time frame. The market, the same amount of money, was down 34%. We've already seen this. The market was down 34% for the year. And this isn't for the year. It's between, but it's the worst point. It's from the high to the low. If you did the worst point, covered calls perform better in this down market. You cushioned your downside. You cut about a third off your downside. If you're heavily on margin, this could be the difference between getting a margin call or not. These covered calls have a lot of utility. You were down for the year, for the time, instead of being down 34%, your total return is only down 20%. So the lightning spread and the covered call both added alpha. You both did better than the market. And that's because you're selling options. Selling options is great. Because of the path dependency element and what you have to do when you have to settle up the option and how the market behaved, you're doing better in the covered call strategy than the lightning spread. But what do you want to bet? It's going to be exactly the opposite if we choose a face ripping market. Let's just do the past 2 years. That's been pretty face ripping. Or let's do the past 3 years. Now we're going to go back to the lightning spread because that's mainly what we're talking about. So if you're doing this at home, you hit sell put 30 delta, buy put 20 delta. If you have a Tasty Trade account, this is free, and this back tester will, in my opinion, is a great way to practice, to look at strategies and try to plan tactics. Okay, so here's the lightning spread, and let's run it for the past 3 years. Or now let's do this. Let's just run it in the tech sector mania. This is 2021. I wonder if you bought on January 1st, 2021 and held it to December 1st, 2021. In Google, that probably would have turned out pretty well, even better in NVIDIA, but it's probably going to be pretty well. And you're going to probably do pretty well. And then let's see what happens. And I can already tell you the covered call should do worse because we had a market where the path dependency, the path of the market was up a lot of weeks. You had a lot of weeks where it went up and we're selling calls. So we're having to settle up in bullish situations. Not that it may still not be a great strategy, and it might, we'll see. We'll just see. But so let's get the lightning spread out for comparison purposes. Tech sector mania, Google. Heck yeah, look at this. Max drawdown was only 5.69%. Of course, the market didn't go down much, but still we got about that's 25% less. So that, it may just not look like a big difference, but it's 25%. It's a pretty significant difference. Great job, lightning spread. Did a good job protecting our capital in this up market anyway. It definitely protected capital. We got 34% total return. I mean, that is really good. That is really good. So now let's do the covered call. And I'm betting the covered call has a lower drawdown. or actually, we'll see. We'll see. I don't know what's going to happen, but I'm betting this for sure. I bet the covered call has worse total return. I bet the covered call does not make 34%. And I don't know about the drawdown. For the drawdown, we'll have to find out together. It's probably about the same because the market really didn't go down. So this isn't really a test of the drawdown. All right, so sell. We'll just switch that to sell call. We're going to leave it on 30 delta. We don't need the other leg. All right, so let's see how we did. And I'm saying we won't make 34% because we're totally capped. Or we're capped over the strike. Yeah, sure enough, we made 21%. All right, so the lightning spread in a bullish market uncapped 50% of extra upside. That's wonderful. And the lightning spread in the bearish market, it's not like it lost more than the market. Remember, it was down 32% and the market was down 34%. It gave a little bit of protection. But in a bullish market, it picked up an extra 50% versus a covered call strategy. The covered call was down 4.8. The other one was down 5. They both protected capital. The covered call protected it a little bit better in this case, but that's pretty much a tie. But the 21% against 30%, that's not a tie. That is a significant difference. All right, let's do this on one other stock. Let's do this on NVIDIA. So we're going to go back to the lightning spread. Selling the 30 delta call, buying the 20 delta. I'm sorry, selling the 30 delta put and buying the 20 delta put every 5 days. So we're doing this once a week. This is how Yield Max does it. I mean, a lot of companies do, they're in the weekly time frame. You do this once a week. Because remember, they're really trying to earn that $49 a week. That is the difference. But I mean, you saw the income, and it would average $45. Now that was back in 2022. Anyway, but the reason that they're trying to earn the money, the covered call earns some yield, and this earns some yield also. All right. So here's the lightning spread, and we'll do it on NVIDIA. All right, lightning spread on NVIDIA. All right, this is pretty good. Drawdown 8%. The drawdown of the market was 24%. So the lightning spread did a fine job protecting capital here. Of course, the market didn't go down that much, but 24% in NVIDIA, that's a decent sized pullback. We only suffered about a third of that. So that's good. That is really good. The return on used capital on NVIDIA for the lightning spread is 38.6%. Now, I'm betting the covered call will not do 38%. But it might have a little bit less drawdown. We'll see. We'll see. We just have to switch this to call. 100 shares of stock. Trying to beat 38%. It's not going to. It's going to be less. Yeah, 19%. All right. What does that tell you? It all deals with the path dependency. And the path of this time frame was not very many big down days, so the lightning spread didn't have to settle very many losing trades. And that's why, even though NVIDIA was down 24%, the lightning spread was only down 8%. Covered call strategy was only down 7% in the time that NVIDIA is down 24%. That's wonderful. But they left more money on the table. They only made a 19% total return, where the lightning spread made a 38% total return. The lightning spread's totally badass, and I wasn't trying to throw shade at it this morning when I was just saying, but you have to know what you're obligating yourself to do when you sell options. Options are just like life. It's just like in life. Of course, I always talk about there's no free money, but also in life, there's no one right thing to do at all times. There just isn't. There's always a trade-off. Let's talk about health insurance. Let's say you're looking at two policies, and let's say one policy charges you $1,000 a month, which is pretty expensive, but you have a $20,000 deductible, meaning you have to come out of pocket until you get over the $20,000, but you only have to pay $1,000 a month. Okay, and you're looking at another plan where the premium is $2,000 a month. but the deductible is only $1,000, meaning you don't have to come out of pocket as much, but you do have to pay twice as much monthly. No right or wrong answer to that. The insurance company's gonna put the numbers where they come out fine either way. There may be a right or wrong answer for you, but there's no right or wrong answer for everybody. Now, it depends on your path dependency of your health. If you think you're going to have a really healthy year, if you're a healthy person and don't anticipate going to the doctor, now you can't always plan it. But if you're super healthy, don't anticipate going to the doctor, you'd be better off just paying the $1,000 a month and just kind of taking a chance on the higher deductible. If you have a year where you end up going to the doctor, and let's say you have a major surgery, well, you're probably going to save money spending the extra money on the premium and getting the deductible getting the insurance package with the lower deductible. There's no right or wrong answer. And that's just the way life is. And that's the same thing with options. You can do a covered call strategy, push your risk to the bullish side, get a yield. You can do a put strategy, you do a lightning spread, push your risk to the bearish side, still get a yield. And you can see the lightning spread did better in a bullish market and did a little bit worse in a bearish market. I mean, that's just the way it works. It's just math. It's just math. Now, here's the other thing. Here's the big caveat. This is assuming we just checked a couple of stocks, but I've checked like 10 more. I have a bunch of these. I have a whole nother video, but I'm not going to bore you guys with that. This was enough to get the point across. This is the way it works every time. Here's the thing that this isn't factoring in. What you're paying the guys at X Funds, David Nicholas, to do, and he has an investment committee. I think they said they meet Mondays or something like that. All right. What you're paying them to do is put good stocks in there. They're going to try to give you stocks that don't go down very much. A lot of this comes down to their stock picking. Okay. They're going to build a portfolio of stocks. But once they do that, though, and once they put their spread, their overlay in place, which in their case is a short put spread, then they're subject to the path dependency. Let's say if they have the investment committee meeting on Monday and they generally switch once a week is kind of what it sounded like to him, or they can switch as often as once a week. Okay. But they're still exposed to that stock for a week. And if that stock for the week goes down a bunch, they're going to have a bigger loss than they would had it been covered calls. You'd have to know the future to know which one's right and which one's wrong. If you knew the market was going to go up, you do lightning spreads. But if you knew the market was going to go down, you do covered calls. That lightning spread's not bad, and covered calls aren't bad. Covered calls have some good features and some bad features. There's a trade-off for everything, just like there is in life. All right, guys, that's my story. I'm sticking to it. Have a good night.